What if your portfolio could pay you a paycheck every single month? In this video, I'm showing you 5 monthly dividend ETFs that can literally put cash in your pocket while you sleep. And I'll show you how to stack them for the perfect income plan. What if you could build a second income stream that pays you every single month like clockwork? That's the dream of passive income, and for many it feels like a fantasy reserved for the wealthy. But it's more accessible than you think. Dividend ETFs are one of the most powerful tools for creating that income, even if you're just starting out. Forget the headache of trying to pick individual winning stocks. These funds do the heavy lifting, pooling together a diversified basket of dozens, sometimes hundreds of quality dividend-paying companies into a single, easy-to-own investment. It's professional-grade diversification made simple. But here's where it gets really exciting. Most individual stocks pay dividends quarterly, creating an inconsistent cash flow that doesn't align with our monthly expenses. Your rent, your car payment, your bills, they all come due every 30 days. So why should your investment income be any different? Monthly dividend ETFs are specifically designed to solve this. By strategically holding stocks with staggered payout dates or using clever income-generating strategies, they deliver a consistent payment directly to your account every single month. This transforms your portfolio from a number on a screen into a reliable cash flow machine, making it easier to budget and plan your financial life. However, not all dividend ETFs are created equal. Some are built for maximum monthly cash flow right now, while others focus on growing their dividends over time. Some stick to reliable blue-chip stocks, while others use complex option strategies to boost their yield. Choosing the wrong one for your goals can be a costly mistake. That's why in this video we're cutting through the noise. We'll explore the core strategies, the hidden risks, and the unique benefits of each category. By the end, you'll have a clear roadmap to confidently select the right ETFs for your personal financial journey. Let's break down the 5 types you need to know. First up, we have the bedrock of any income portfolio, broad market dividend ETFs. Think of these as your safe, steady paycheck, the foundation upon which everything else is built. Their primary strength lies in one word: diversification. These funds don't just hold a handful of stocks, they own hundreds of companies spread across every major sector of the economy, from technology and healthcare to consumer staples and financials. This means you're not overly exposed to the fortunes of any single industry. If tech stocks take a hit, the stable utility and consumer goods companies in the fund can help cushion the blow. They typically invest in blue-chip, large-cap companies, household names with long track records of profitability and paying dividends. The yield isn't going to be the highest you can find, but that's by design. You're trading flashy returns for fortress-like safety and reliability. When you're starting out, this is where you want to begin building your monthly income stream. Second, we have dividend growth ETFs. If broad market funds are about stability, these are about momentum. These funds specifically target companies with a proven history of increasing their dividend payments year after year. We're talking about dividend aristocrats or dividend champions, companies that have consistently raised their payouts for decades. The initial monthly payout from these ETFs might seem smaller than other types, but here's the magic. That income stream isn't static. It grows. This is the power of compounding working in your favor in 2 ways. Your investment grows, and the income it produces grows. Imagine a fund that yields 3% today. If its underlying companies grow their dividends by 10% annually, your income from that same initial investment will double in about 7 years. Your yield on cost becomes 6%, then 7% and beyond, crushing inflation over the long term. This is how you move from just earning income to building true, lasting wealth. Third on our list are the income powerhouses, covered call ETFs. These are a bit more complex, but they can generate some of the highest monthly yields available. So how do they work? In simple terms, the ETF holds a portfolio of stocks and then it rents them out by selling options contracts on them. This is called selling a covered call. For selling this option, the fund receives an immediate cash payment called a premium. The fund does this systematically across all its holdings, collects all these premiums, and then passes that income along to you as a juicy monthly distribution. They are true income machines, but there's a critical trade-off. By selling that option, the fund agrees to sell the stock at a predetermined price. If the stock's price skyrockets past that level, the The fund's upside is capped. You miss out on the explosive gains. You're essentially trading away potential home run growth for a much higher and more consistent monthly paycheck. These can be excellent tools in flat or sideways markets where you can collect income even when stock prices aren't moving much. Fourth, let's talk about real estate with REIT ETFs. REIT stands for Real Estate Investment Trust. These funds allow you to become a landlord on a massive scale, but without ever having to deal with tenants, toilets, or late-night repair calls. By law, REITs must distribute at least 90% of their taxable income to shareholders, which is why they are such fantastic dividend payers. And the best part is the diversification. You're not just investing in apartment buildings. A single REIT ETF can give you ownership in hundreds or even thousands of properties across various sectors. There are industrial REITs that own the warehouses and logistics centers that power e-commerce, data center REITs that house the backbone of the internet, healthcare REITs that own hospitals and senior living facilities, and even cell tower REITs. You get instant diversification across different property types and geographic locations, professional management, and the ability to buy or sell your stake with the click of a button, a level of liquidity that's impossible with physical real estate. Finally, we have the anchor of the income portfolio, bond or short-term income ETFs. These are your most conservative plays designed for capital preservation and predictable income. When you buy a bond, you're lending money to a government or a corporation and they pay you interest. A bond ETF is simply a diversified basket of these loans. Their primary role is to act as a shock absorber for your portfolio. When the stock market gets volatile and stock prices fall, high-quality bonds often hold their value or even increase, providing a crucial counterbalance. This is the key to sleeping well at night during a market correction. Within this category, you have ultra-safe ETFs that hold U.S. Treasury bonds, as well as corporate bond ETFs that offer slightly higher yields by lending to stable companies. The growth potential is minimal, and that's the point. You're not buying these to get rich. You're buying them for reliable, predictable monthly paychecks and to protect your hard-earned capital when other parts of the market are in turmoil. They provide the stability that allows you to stay invested for the long run. So how do you put this together? Here's a simple breakdown. Conservative investors focus on broad market plus bonds. Balanced, mixed growth REITs and bonds. Aggressive, load up on covered calls plus growth. The secret is in combining these ETFs so you get cash flow every month while managing risk. Now here's the kicker. If you reinvest your dividends, your money compounds faster than you think. $100 invested monthly into dividend ETFs, reinvested over 10 years, could snowball into thousands more than just cashing out. So there you have it. Monthly dividend ETFs represent one of the most accessible paths to generating consistent passive income. We've explored the entire spectrum, from the bedrock stability of funds that anchor your portfolio to the balanced approach of growth-focused ETFs, and even the high-yield players for those seeking to maximize cash flow. The key takeaway is that there's a strategy that can be tailored specifically to your financial goals, your timeline, and your comfort with risk. It's about finding the right tool for your personal wealth-building toolkit. Remember, building a dividend portfolio is a marathon, not a sprint. The real magic happens over time through the incredible power of compounding. Every dividend you receive, especially when reinvested, acts like a tiny employee working to generate even more income for you. This creates a financial snowball that can dramatically accelerate your journey. It's about creating a system that works for you, month after month, providing not just income, but the peace of mind that comes with building a secure financial future, one step at a time. The most important step is the first one. If you're ready to turn this knowledge into action, you'll need a reliable brokerage account. To help you get started, I've partnered with Webull. They offer a powerful, user-friendly platform, and as a bonus for our community, signing up with the link below and making a deposit gets you up to 12 free stocks. It's a fantastic way to kickstart your portfolio with extra capital from day one. If this breakdown helped clarify your strategy, please hit that like button. It helps the channel immensely. And subscribe so you don't miss our next deep dive. I'd love to hear from you in the comments. Which ETF strategy are you most excited about? Let's build wealth together.